We often think about a company's financial health by, digging into the numbers, profits, debts, assets, all that
Yeah,
stuff.
balance sheets.
Exactly. But you've got to wonder, don't you, what about the people actually running the show? Does the skill of the management team tell us anything? Anything about how risky they are?
Well, that's really the core question we're tackling today. We're trying to shift the focus a bit, away from just the spreadsheets,
Okay.
to look at whether the ability, the actual skill of a company's managers has a real effect on, well, how risky it is to lend them money.
Interesting. And to explore this, we've got a piece of research, Managerial Ability and Credit Risk Assessment.
Hmm.
This study was published in Management Science back in 2016. The authors are Samuel B. Bonsall IV, Eric R. Holtzman, and Brian P. Miller. And Management Science, that's a publication of Informs based out in Maryland.
Yeah, a well-regarded journal.
Yeah.
So our goal with this deep dive, really for you, the learner, is to unpack this research. We want to understand if and maybe how the talent of the leadership influences credit risk.
Going beyond just the standard financial figures.
Yeah, exactly, to see what role management actually plays in the eyes of, say, lenders.
All right, so let's get down to brass tacks then. What exactly does managerial ability mean here in this research context? It's not just about having a really charismatic CEO, is it?
No, not at all. Not just charm. The researchers lean on a definition from Demerjian and some colleagues back in 2012. They defined it as managers' efficiency relative to their industry peers in transforming corporate resources to revenues.
Okay, efficiency in turning resources into revenue compared to their peers.
Exactly. Think of it like this. How good is a management team at taking everything they have, assets, people, capital, and turning it into sales, compared to how other companies in the same industry manage it?
Right, so it's about being sort of lean and effective with what you've got.
Precisely. And that covers a lot,
Mhm.
understanding technology shifts, guessing what customers will want,
Predicting demand, yeah.
making smart investments, managing people well. It's quite a comprehensive view of just, well, how well the business is run.
And the paper mentions this isn't just some abstract concept, right? Past research already linked this skill to things like better future profits and stock returns.
Yeah, that's a key point. Prior work had shown that connection. Equity investors, people buying stocks, they've kind of known for a while that good management matters for future earnings and returns.
Okay.
What's maybe less explored, and what this paper dives into, is whether that same idea holds true in the debt market, where the focus is maybe more on downside risk, on avoiding losses.
Which brings us to their first big point then.
Yeah.
About earnings stability. The idea was that better managers would probably lead to smoother, more predictable performance.
That's the hypothesis, yeah. Less variability, fewer big unexpected swings in earnings or returns.
Makes sense. And did the data back that up?
It did.
Yeah.
The study found a statistically significant negative relationship between their managerial ability score, they call it MAS score,
Mass score, okay.
and the volatility, the standard deviation of future earnings, specifically return on assets or ROA, and also stock returns.
Okay, hang on. So a higher score, meaning better managers,
Yes,
was linked to lower volatility. So more stable results down the line.
exactly. That's the finding. And crucially, this link held up even after they controlled for how volatile the company was in the past and a bunch of other standard company factors.
How did they control for that?
Well, they used some pretty standard but robust statistical techniques, like regressions with fixed effects and also first differences, basically ways to try and isolate the impact of managerial ability itself, filtering out other noise or potential explanations.
Got it. And the stability thing, that's huge for lenders, isn't it? A company with steady earnings is just safer.
Absolutely. Predictability is gold when you're assessing the chance of default. If a company consistently generates cash, you feel better about getting paid back. So the findings suggest these more capable managers deliver that stability.
Okay, that sets the stage really well. So how did they then connect this managerial ability, this mass score, to the actual credit ratings? The S&P grades, the Moody's grades.
Right, this is the core finding. They found a significant positive link. Higher managerial ability, a higher mass score, was associated with higher credit ratings from Standard & Poor's.
Higher ratings meaning lower perceived risk.
Exactly. Better grades mean the agency sees them as less likely to default on their debt.
And again, I assume they didn't just look at a simple correlation. They must have controlled for all the usual suspects. Company size, assets.
Oh, absolutely. They threw in a whole battery of controls. Things like company size, capital intensity, how much fixed assets they have leverage, profitability like ROA, past performance.
It works?
Pretty much. They used ordered logic regressions, which are suited for this kind of ordered data-like ratings. Plus, they included firm and year fixed effects, again, to account for things specific to the company or the overall economy in a given year. And they use first differences, too.
So after all that, did managerial ability still seem to matter much? Or was it just a tiny effect compared to, say, profitability?
No, it wasn't tiny. They actually calculated the economic significance. They found that moving a company from the bottom quarter to the top quarter in terms of managerial ability.
Like a decent jump in skill.
Right. That jump was linked to about a 0.13-notch improvement in the credit rating. And interestingly, they note this impact is comparable in size to the effect of a similar-sized jump in return on assets.
Wow, okay. That's actually pretty substantial for something that isn't, explicitly on the balance sheet.
It really is. And it kind of fits with what the rating agencies themselves say, doesn't it? So paper pulls some interesting quotes.
Oh, yeah. Like what?
Well, they mentioned that both Moody's and S&P talk about management quality in their methodologies. There's a quote from S&P in 2008 saying meetings with management help their qualitative assessment of management itself.
So they're trying to size up the people.
Seems like it. And another quote from Gangun and Billardello in 2005 calls management's influence irrefutable. So the agencies acknowledge it's important. This research kind of quantifies that importance for ratings.
It suggests maybe investors could get a better view of risk by thinking about management, maybe even beyond what the agencies capture, though figuring out that mass score for every company might be tricky for an individual, perhaps.
That's a fair point about data availability. But the principle holds. Okay, so the agencies say they look at it, the data shows a link to ratings, but the researchers went further, right? They look at CEO changes.
They did. This is a clever way to get more direct evidence. They looked at cases where a CEO leaves and a new one comes in.
Okay.
The logic is, if managerial ability really matters for credit risk, then swapping out a less able CEO for a more able one should, other things being equal, lead to an improvement in the credit rating, a kind of natural experiment. And what happened? Did ratings tend to go up when a higher scoring CEO took over?
That's what they found, looking at, I think it was 44 CEO changes. There was a tendency for credit ratings to improve when a CEO with a higher measured ability replaced one with a lower score.
Huh. That's pretty direct evidence, then. It really suggests the market, or at least the rating agencies, react to perceived changes in leadership competence.
It does feel quite intuitive, doesn't it? Like, okay, there's a perceived upgrade at the helm. Maybe things are a bit safer now.
Yeah, exactly. Now, the paper also dug into when this managerial ability matters most. It wasn't always equally important, was it?
No, context mattered. They found a few situations where it seemed to play a bigger role.
Like what?
First, in more uncertain environments. So for companies that historically had really volatile performance,
With lots of ups and downs.
right, for those firms, a change in managerial ability had a more pronounced impact on their credit rating changes. Like when things are choppy, having a good captain matters more.
Makes perfect sense. A steady hand in a storm. What else?
Second, it mattered more in firms with low capital intensity. So companies that don't rely heavily on big physical assets, like factories or machinery.
More service-oriented, maybe? Or tech?
Could be. The idea is that in these firms, managers have more operational flexibility, more levers to pull, so their decisions and skills have a more direct and immediate impact. Less is tied up in fixed assets.
Okay, so where management has more direct influence day to day, and the third situation.
High-growth industries. They saw a stronger connection between changes in managerial ability and subsequent rating changes in industries with lots of growth potential. They mentioned examples like healthcare, medical equipment, computers, pharmaceuticals.
Fast-moving sectors.
Exactly. In those environments, you really need sharp management to spot opportunities, react quickly, make the right bets. Their skill is arguably more critical than in a very stable, slow-growth industry.
That all seems logical. Better managers shine brighter when things are uncertain, when they have more operational control, or when the industry is moving fast. Now, a skeptic might ask, couldn't this just be about connections? Managers cozying up to rating agencies. What did the researchers call it? Economic bonding.
Yeah, economic bonding. That's a valid concern.
Mm-hmm.
Are managers somehow unduly influencing the agencies?
Hmm?
They ran several tests to try and rule this out as the main explanation.
What kind of tests?
For instance, they checked if the effect was stronger for CEOs who'd been there a long time, thinking maybe they'd built up relationships.
Okay.
They also looked specifically at ratings right around the investment grade versus junk bond cutoff, where you'd think the pressure to influence ratings would be higher.
Right, a critical threshold.
And they looked at firms that had loan agreements where the interest rate actually changed based on their credit rating, a direct incentive for management to push for a better rating.
So, across all those situations where influence might be stronger, did the link between ability and ratings change much?
Nope. They found the impact of managerial ability was pretty consistent. It didn't seem to be significantly stronger in those specific scenarios. And one more thing they did.
Yeah.
They looked at ratings from a different kind of agency, Egan-Jones. It's an investor pay model, meaning the investors, not the companies issuing the bonds, pay for the ratings. That structure reduces the potential for the company to influence the outcome.
And the results held up even with those ratings.
They did, which really strengthens the case that it's genuine managerial ability being assessed, not just influence or relationships, driving the positive association with ratings.
Okay, that's convincing. So it seems like the ratings do reflect, at least partly, an assessment of actual skill. Now, ratings are one thing, kind of an opinion on risk. What about the actual cost of borrowing? Did companies with better managers pay less interest?
Yes, that was another key finding. Higher managerial ability was associated with narrower credit spreads.
Credit spreads. That's the extra interest a company pays compared to a super safe government bond, right?
Exactly. It's the risk premium. A narrower spread means the company borrows money more cheaply.
And was this just because they had better ratings? Or did managerial ability seem to have its own separate effect on borrowing costs?
That's what's really interesting. Their analysis suggested that this effect on spreads was incremental to the information already captured in the credit ratings, meaning that bond investors themselves seem to be directly pricing in managerial ability, even beyond what the rating agency is telling them. They value that skill independently.
So the bond market pros are looking at management quality too, and it affects the price they demand.
It appears so. They're not just relying on the S&P rating, they're making their own assessment. And managerial ability seems to be part of that calculation, leading to lower costs for firms with better managers.
What kind of difference did it make, financially speaking?
They estimated that the same kind of jump we talked about earlier, moving from the 25th to the 75th percentile in managerial ability, was linked to about a 9 basis point reduction in credit spreads.
9 basis points, that's 0.09%.
Right, which might sound small, but they point out it's about a 6% decrease compared to the median spread in their sample. For a company borrowing billions, that adds up to real money saved over the life of a bond.
Definitely non-trivial savings. So just to wrap that part up, it seems like there's a pretty solid case here. Better managers lead to more stable performance, which is reflected in better credit ratings.
Yep.
And it even seems to translate directly into lower borrowing costs in the bond market itself.
That sums it up well.
Oh,
And just as a final check, they did a couple more tests. They made sure these results held, even when accounting for how CEOs are incentivized.
yeah.
How much they're paid depends on stock price movements, which might affect risk-taking.
Okay. Controlling for incentives.
Right. And they also tried using a different performance measure, looking at ROA compared specifically to industry peers. Even with those adjustments, the main story stayed the same. Better managers linked to better ratings and lower credit spreads.
Okay. So the core message seems robust. The key takeaway, then, for you, the learner, from this deep dive is pretty clear. When you're sizing up a company's financial health, don't just look at the numbers.
Right. You need to think about who's actually in charge.
The skills, the efficiency of that management team, it's a significant factor. Debt markets, rating agencies, bond investors, they all seem to consider it when they assess risk.
Yeah, it suggests that strong management can act as a kind of buffer, providing resilience and potentially leading to better borrowing terms for the company. This research really shines a light on that often overlooked, less tangible asset.
That invisible asset, as you called it earlier, can have very real, measurable consequences.
Exactly.
Which leads us nicely to a final thought for you to mull over. If managerial ability is so important for creditworthiness, how can someone like an individual investor or an analyst really get a good handle on it? It's not like there's a simple number on the quarterly report. Beyond the financials and the official ratings, what are the clues? What qualitative things might tell you about the real capabilities of the team running the company? Definitely something worth thinking about next time you're evaluating a potential investment or assessing risk.